I've got breaking news for you. There is a historic spike in natural gas prices ahead. And this unavoidable price spike will create an explosive profit opportunity. What I'll reveal to you today is the single best way to profit from this coming price surge. Friends, an epic shift is unfolding right now in the natural gas sector that is unlike anything I've ever seen. Thanks to a historic weather pattern and a mind-boggling disappearance of natural gas rigs, the price of natural gas is about to soar, sharply higher. Early last fall, the supply-demand setup for natural gas looked to be taking a modest bullish turn. But then something suddenly happened to trigger a massive shift, one that most investors have missed to date. As you're about to see, this shift virtually ensures a natural gas spike of epic proportions in the weeks ahead. Over the next few minutes, I'll show you what triggered this development, and I'll show you how a massive spike in natural gas prices is a virtual certainty. And I'll show you the very best way to play this imminent spike for maximum profits. I bought this stock because I think it's possible for me to double my money in the months ahead thanks to this unique combination of a superstar company set to explode and a historic shift in natural gas prices that's already underway. Let me show you what I mean. The return of El Niño killed natural gas demand. I started investigating the fundamentals around natural gas supply and demand early last fall. I could see that something bullish was starting to form, but then something huge happened. The return of El Niño. Thanks to this historic weather event, North America got a freakishly warm winter, one that sent the global warming crowd into a tizzy. Look at this chart of the United States. The entire Northeast and Midwest was warmer than normal last year. According to the NOAA, the lower 48 had its warmest winter in 121 years. Between December and February, the temperatures were 5 degrees above the average of the last 20 years. The winter of 2015-2016 was literally off the charts hot. See the chart at the far right-hand corner. Average temperatures were much higher. And the trend is clear. But that freakishly warm winter did something other than ring the global warming alarm bells. It killed demand for natural gas. See how the number of heating degree days was much lower this past winter. That sudden and very sizable demand drop caused the bottom to fall out on natural gas prices. Last winter's El Niño and the subsequent crash in natural gas prices has set up the biggest opportunity to profit that I've come across in the energy market in years. Here's why. Everyone has been focused on temporary demand factors that caused the bottom to fall out on natural gas prices. But everyone is missing the single most pivotal event in the natural gas market in 10 years. After years of growth, no matter what the price of natural gas is, supply growth has now disappeared. Listen, if we had experienced just a normal winter, natural gas prices would be double where they are now. But instead, thanks to El Niño, we saw a collapse in prices that has crippled the entire industry of natural gas producers. The events that this warm winter has put into motion is setting the market up for a natural gas price spike of epic proportions. In just a moment, I'll show you the single best way to play this coming price spike with a company poised to soar sharply higher. But first, I need to tell you about another factor in this unavoidable price spike. The flow of capital to natural gas producers has been cut off completely. There's an old saying in the commodity business, there is no cure for low prices like low prices. It isn't just a saying, it's the truth. If prices aren't high enough for producers to turn a profit, they stop drilling. This cure for low natural gas prices was already working before this warm winter came along, and then it got worse, much worse. The way the low price cure works is pretty simple. It's essentially a starvation diet. The natural gas producers are being starved of cash. First, the producer's cash flow has been crushed. Take Southwestern Energy, for example. In 2014, Southwestern generated earnings of $2.3 billion. Last year, that number plunged to $1.4 billion as commodity prices declined. But get this, for 2016, Southwestern Energy is only going to generate $500 million. See this slide from a sell-side analyst report. Adjusted EBITDA will be somewhere between $450 and $500 million. That means that Southwestern is going to have only 1/5 as much cash flow in 2016 as it did 2 years ago. Simple mathematics can tell us what's going to happen to supply when cash flows fall apart like this and drilling comes to a screeching halt. This isn't unique to Southwestern either. It's the case for all natural gas producers. The reason these cash flows are so decimated is simple. Natural gas prices are just too low for these companies to make any money. Drilling natural gas wells at current prices is a money-losing proposition. And with drastically reduced cash flows, there is no money for new drilling. But it gets even worse. On top of that, the banks have come down hard on these companies. Banks who lend to the energy sector are now struggling with bad loans. The oil route on top of depressed natural gas prices has the banks swimming in even more bad debts. This means that credit lines are being cut, and for producers, the ability to borrow money to drill has been cut off. Not being able to borrow more means that natural gas producers have to live within their cash flow. And as you just discovered, their cash flows are almost non-existent. This process of shrinking cash flows and a decline in drilling was already happening before El Niño showed up. But thanks to El Niño, the entire industry has collapsed. And then there's the mysterious disappearance of 1,500 natural gas rigs. How bad is the current scenario for natural gas producers? I showed you how bad it is for Southwestern Energy. Cash flows are 20% of where they were just 2 years ago. After paying interest on their debt, there is hardly any cash left over for new drilling. It's important to note that this isn't an average natural gas producer. In 2015, Southwestern was the third largest natural gas producer in the entire country. So if this heavyweight natural gas producer with top quality assets can't make a go of it, what is happening to the average mid-sized producer with average assets? Or a small producer with average assets? Or any company with below average assets? I'll tell you what's happening. All of these companies are shutting things down. Some of them are going bankrupt, and some of them are hanging on by a thread. There is no better proof of this than the chart below. See how the rig count has almost disappeared over the last few years. The United States natural gas rig count peaked at 1,606 on September 12, 2008. As of last year at this time, it had plummeted to just 400. And today, the natural gas rig count in the United States is 86. Let me make sure I'm clear on this. I said 86 rigs. That is not a typo. That is down 95% from the high. We are now at the lowest level in 29 years. And there is no disputing this fact. There is a massive natural gas supply shortage emerging. Drilling has come to a complete halt. And to have natural gas production, you need to drill wells. This emerging shortage will get worse because so much of U.S. natural gas production comes from shale now. Have you ever seen how fast shale production drops? It was a huge moment for the U.S. when the industry cracked the code on shale gas production. It saved all of North America from a supply crisis this decade. But shale gas does have its own challenges. You see, the rate of production from shale gas wells declines incredibly fast. Daily production from gas wells typically drops 70% in their first year. 70%! It is literally a case of here today, gone tomorrow. Without a constant and high rate of drilling, U.S. natural gas production will fall. In year 2, production drops rapidly as well. By the end of year 3, a shale gas well will produce a mere 10% of its initial rate of production. Look at this chart. See the hyperbolic decline in production in the first 8 months of a shale gas well's life. It slowly drops off, but it still drops off a lot to only 10% by year 3. It doesn't take an advanced degree to make the connection here. 1, we know for a fact that the natural gas rig count has collapsed. 2, we also know for a fact that shale gas production declines very quickly. So with very little drilling being done, shale gas production is going to fall, and it is going to fall fast. The third thing we know is that shale gas has become essential to the United States. As you can see here, shale gas now produces more gas than conventional gas. Despite having only been around for a decade, shale gas is already the biggest source of natural gas supply in the United States. Natural gas production from other sources are already in decline. So with shale gas wells having hyperbolic decline rates and drilling coming to an almost complete halt, we know that the production response will be significant. The entire market has been lulled into the idea that we are never going to be short natural gas again. There is an awakening coming. And with an entire industry not drilling wells, there just isn't going to be enough supply. That simple fact sets up an extraordinary profit opportunity for those forward-thinking energy investors who know where to look. And that's where I come in. How to exploit this massive market shift for maximum profits. My name is Keith Schaefer, and I'm 8+ years into running the Oil and Gas Investments Bulletin. My portfolio performance over that time has exceeded my wildest expectations. You're probably surprised to hear that, given the fact that the oil and gas sector has been decimated over the last few years. How have I been able to thrive while the industry I'm focused on has fallen apart? I owe it all to being very patient and waiting for the exact right time to get long a market trend. In March 2009, I launched my Oil and Gas Investments Bulletin because I believed we were at a generational buying opportunity. And I was proven to be correct. There have been a few other huge turning points. In July 2014, I told my subscribers that I was getting out of the majority of my oil producer holdings. Here's what I wrote. My sense is that commodity prices have peaked for now for both oil and natural gas. When I was a younger man, I used to believe my stock picking was so good my stocks could withstand the market. After all, I own the best growth stocks on the board. Yeah, right. Age has taught me that 75% of stocks go up and down with the market. And even though I do have good stocks, they follow trends. And with this email, I started selling almost all my producers' oil stocks. My subscribers and I got in the bottom in 2009 and out at the top in 2014. My thinking in 2014 was that oil was already at $100 per barrel plus. And aren't you supposed to sell when prices are high? That was an even more important decision for the OGIB portfolio than jumping into oil producers in March 2009. While many of my colleagues have been ruined by the oil collapse, my portfolio has continued increasing since oil prices crashed. I owe this success to a very simple theory. I believe the cyclical nature of the commodity business is there to be exploited, not to be suffered from. When prices are high, the upside is limited, but the downside is huge. Likewise, when the commodity prices are low, the upside is huge and the downside is limited. This trading philosophy works for other segments of the energy sector as well. This has allowed my subscribers to successfully ride other trends in the energy business to profits. In 2013, a $30,000 per year investment service that I subscribed to showed me the light on why I should be getting long ethanol for the next 9 to 12 months. That is a benefit that my subscribers get from my service. I spend a lot of money on high-quality research. I did my own due diligence and identified Pacific Ethanol as the stock to own, and I rode it from $3.15 in November 2013 until I sold the last bit at $23 per share in July 2014. Like oil, ethanol is a commodity that can be exploited for profits. You don't just go long and hope for the best through the crashes, folks. In 2011, I made a similar successful trade with refinery stocks, taking advantage of discounted North American oil prices. It was again a situation where the fundamentals were set up for significant profits. I've also had a couple good runs with shipping tankers, doubling my money twice on Golar over the years. It's a cyclical business where changes in supply and demand can create opportunities. The one part of the energy business that I have steered clear of is natural gas. That is, until now. I have successfully rode the cycles of oil, ethanol, refiners, and shipping tankers, and even solar companies. Now I'm ready to do it with natural gas by investing in the best natural gas company in the business, a company whose shares are poised to soar in the weeks ahead. And I'll give you a risk-free report on this company in a few minutes. Right now, the important thing for you to know is that the clock is ticking, and now is the time to get in on this trade. I believe it's the biggest opportunity I've found yet. everything is set up for a historic rally in natural gas, and I'll show you just how to exploit this rally for maximum gains in just a moment. For now, let me tell you why even the biggest companies are closing up shop. I already showed you how Southwestern Energy's 2016 cash flows have been almost wiped out. Southwestern is the third largest natural gas producer in the country. The second largest natural gas producer, Chesapeake Energy, has even bigger issues. It may survive, or not. Remember, these are the big boys in the industry. These are the companies that have the best assets and the best operating teams. I've got to tell you, I've never seen any industry grind to a halt like this. All of these big companies are doing the same thing. They're hunkering down, shutting off spending, and just trying to survive. I've modeled how much production these companies as a whole are going to be generating over the remainder of 2016. The model shows a massive collapse in production is coming. Let me show you what I mean by using the country's second largest producer. Like Southwestern, Chesapeake has a cash crunch. Natural gas prices are too low to generate much cash flow. The banks are done extending any more credit, and to top it off, share prices are too low to issue equity. In the first quarter of 2016, Chesapeake spent just $365 million drilling and fracturing wells. Compare that to the first quarter of 2015 when they spent $1.5 billion. Chesapeake's spending year on year is down 75%. The spending tap has been almost completely shut, and that is impacting Chesapeake's rig count in a huge way. In the first quarter of 2015, Chesapeake had 54 rigs drilling wells, but in the first quarter of 2016, that number was just 8. That is an 85% decline year on year. And those rigs were exclusively drilling shale gas wells, the kind that lose 70% of their initial production within 1 year. This isn't a decline in drilling. This is an utter collapse in drilling, which will result in an absolute collapse in production. The warm winter that really crushed natural gas prices this past winter did something else. It set up what is going to be an epic price rally for both nat gas and nat gas stocks. The important thing to note is that the really big drop in the rig count happened in the first quarter of 2016. Now look at the chart below. Production had already started to decline before the really big drop in rigs. December 2015 marked the first year-over-year supply decrease since February 2010. In the coming weeks, the market will be shocked at how fast U.S. production is falling. This is going to light a fire under natural gas, which is why it is critical that you get positioned for this historic natural gas rally right now. Supply. Every onshore play is declining now. When this year's El Niño winter hit, it crushed natural gas prices. It also crushed the spirits of investors who were trying to make some money on the long side of this commodity. Quite frankly, people gave up. They threw in the towel on natural gas prices and natural gas producers. I've seen this kind of simultaneous mass resignation before. It was in March 2009 when investors gave up on oil and oil stocks. That was exactly when I launched the Oil and Gas Investments Bulletin, at the moment of capitulation. In March 2009, when investors gave up on oil producers, I knew the fix was already in to give them new life. I had done my homework and worked my extensive network of oil market contacts. I was convinced that OPEC had taken enough production out of the market to support the price of oil. I was right. Today, investors have capitulated on natural gas, and just like in March 2009, they have done so at exactly the wrong time. The warm winter has hidden the fact that natural gas production had finally gone into decline. This warm winter was a seasonal phenomenon. The decline in natural gas production is going to take a while to turn around, even after the natural gas prices spike. That's why I expect this natural gas rally is going to be one for the ages. Just like in 2009 with oil, I've done my homework on the natural gas market. Supply is falling in all of the shale plays. The Haynesville shale is declining in Louisiana, as you can see from this chart from the Energy Information Administration in the U.S. Natural gas production is also falling in the Eagle Ford Formation in Texas. In Colorado, the Niobrara Formation, natural gas production is also declining. In the mighty Permian, natural gas production is declining. And most importantly, EIA statistics show that production in the Marcellus Monster in the northeast U.S. has finally started to decline. With these production declines, natural gas prices should have moved significantly higher early in 2016. But they didn't because of the El Nino curveball. Instead, natural gas prices went even lower, and that has brought the entire industry to a screeching halt. A natural gas recovery that should have been pretty normal was delayed. What we are going to get is a historic rally in natural gas prices, one where fortunes can be made by those investors who know where to look. Now, this is a volatile commodity. What you need to understand about natural gas is how incredibly volatile its price can be. There is no other place in the market where you can get short-term trading opportunities like with natural gas. But it's sometimes quite difficult to spot these opportunities. You need to have an informational advantage. You also need the courage to bet against the crowd. The current setup we have is one of those extremely rare opportunities. The market has capitulated. This is easy money if you act now. It's also going to be a trade that should work out very quickly. The light blue line in this chart shows how volatile pricing can be in natural gas, setting up a great opportunity for investors. Unlike most trades that require years of waiting, natural gas prices can double or triple in just a couple months. I'm excited to be on the side where I can profit from the natural gas price spike that is coming at us this year. But I have to admit, I'm also a bit nervous about how severe this spike could be. I've told you all of the damage that has been done to the supply side. Producers are crippled. They have no cash. The banks aren't giving them any additional cash, even if prices spike. These banks have huge problems, not just with loans to natural gas producers, but oil producers as well. Banks are reducing credit lines everywhere. The supply damage alone has set the stage for this price spike. What is adding fuel to the fire, though, is that natural gas demand is exploding at exactly the worst possible time. Coal-fired power is being shut in permanently and shockingly quick. Coal production and consumption in the United States is collapsing, and the beneficiary of all this is natural gas. Look at the far right-hand side of this chart. Coal production is falling off a cliff right now. Over the past 5 years, coal-fired power capacity in the United States has declined by 38.2 gigawatts. Meanwhile, natural gas-fired power generating capacity has increased by 27.3 gigawatts, with most of that conversion happening in the past 2 years. Even more importantly, experts now predict that the move to natural gas-fired power will keep happening in the next 2 years. This will happen as supply of natural gas is falling. Over the course of 2016 and 2017, an incredible 19.2 gigawatts of coal-fired capacity is going to be retired. The replacement for virtually all of that power will be natural gas. You look at the second bottom row, coal retirements in 2016 and 2017. That adds up to a big number. Transitioning from coal to natural gas is exactly what we should be doing. There is nothing worse for the environment than coal. We have the natural gas reserves in the ground to handle the increase in power demand. That is common knowledge and exactly why these power plants are moving to natural gas. What we need to ask ourselves as investors, though, is at what price will that natural gas in the ground be economic and recoverable? Because it certainly isn't where natural gas prices are today. How do we know that? Because a company like Chesapeake Energy has cut its number of rigs by up to 85%. Natural gas prices must go up. And they'll have to go up fast in 2016 to make sure we have sufficient supply to meet demand. Natural gas demand, just from the electric sector, will be up over 3 billion cubic feet per day this summer. That equals roughly 4% of total natural gas production. See this chart? It shows record demand from the electric sector for natural gas this year. Now that may not sound like much, but a 4% swing can be huge for a commodity that is priced at the margin. We don't have to look very far for an example of just how disruptive 4% can be. Global oil demand is roughly 95 million barrels per day. In late 2014, oil prices were absolutely destroyed by the rise of shale oil production in the United States. Do you know how much shale oil production there actually was? Between 4 and 5 million barrels a day, or 4 to 5% of global demand. The demand for natural gas for power generation is enough to be disruptive for prices. What could really turn things on its head and send natural gas prices skyrocketing is the weather. If we have a warm summer and demand for air conditioning is unusually high, power demand could be even higher than expected. Well, guess what? That's exactly what's expected to happen. Mother Nature is pouring gasoline on this fire. Mother Nature decimated natural gas prices this past winter. She has pushed natural gas producers across the country to the brink. Some of these companies are barely generating any cash flow at all after they service the interest payments on their debt. These companies built their balance sheets expecting natural gas prices that are 3 times where they are today. The entire natural gas industry has come to a complete halt. We can see that in a nationwide natural gas rig count total of just 86. Can you imagine? 86 rigs drilling for natural gas in the entire United States. A company like Chesapeake used to have more wells than that drilling just by itself. The really crazy thing is that there is virtually no drilling for natural gas going on, while demand for the commodity is surging. Collapsing supply and surging demand. There is only one possible price response for that. Mother Nature isn't done having fun with natural gas prices either. Just as weather can deflate demand for natural gas, it can cause it to surge. With the supply side crippled, 2016 is shaping up to have an extremely warm summer. That is going to throw another 4 billion cubic feet of demand for natural gas on top of what the conversion from coal is already adding. See record demand expected this summer. And if the market's weather guess is right, North America will have a bitterly cold winter coming up. That's because El Niño is almost always followed by La Niña. El Niño is a weather system caused by hot waters or warm waters off the Pacific coast of Latin America, which for some strange reason causes mild winters in eastern North America. La Niña is almost the opposite, where very cool waters off the Pacific coast of Latin America strangely causes very cold winters in eastern North America, where all the heating demand is. Hot summers add about 3 billion cubic feet per day of demand for natural gas, but cold winters add a full 10 billion cubic feet a day. The market now thinks there could be a massive demand increase this winter, one that the industry can't meet. As June got hot, the market started to believe in La Niña. That has caused nat gas prices to move up off the bottom. And that's why getting in on this trade right now is the key to big profits. Computer models currently see every state in the lower 48, other than Texas and Louisiana, having an unusually warm summer in 2016. That's La Niña. That would mean 90+% of the U.S. population will be consuming more power than normal this summer. See the June-August forecast for the United States. Much warmer temperatures than expected. The market now believes in La Niña. La Niña could bring an extra 10 BCF a day of nat gas demand, while nat gas production is falling. There is only one way for prices to go, and that's up. Let me do a quick recap. Natural gas producers and their lenders are all hunkering down at the same time. The rig count has collapsed. Power generators are all moving to natural gas at the same time as they eliminate coal-fired plants. The market is now expecting a blistering hot summer, and they're getting it. And it's also expecting a bitterly cold winter as El Niño turns into La Niña. Where will natural gas prices end in 2016? Up 100%? Up 200%? Could it be even more? In just a moment, I'll tell you how you can make money from the answer to that question. But there's yet another factor pressing natural gas prices higher. Can we really afford to export natural gas anymore? Because Mexican demand for U.S. gas is growing quickly. From 2005 through 2010, exports of United States natural gas to Mexico were consistently between 0.8 and 0.9 billion cubic feet a day. In 2011, there was a sharp break from this historical trend. Exports in 2011 jumped by 64%. In 2012, exports of natural gas to Mexico jumped by another 24%. That wasn't the end, that was just the beginning. In 2015, natural gas exports to Mexico nearly reached 3 billion cubic feet per day. That's a 300% increase in just 4 years. And you can see what's expected to happen. Over the next 5 years, those exports will double again. Exports to Mexico alone will take all of the production from the prolific Haynesville Shale. It will be as though the Haynesville doesn't exist as far as the United States is concerned. The cause of this demand spike from Mexico is growing Mexican demand combined with no growth in Mexican production. Mexico's state oil company Pemex is in shambles. The oil price collapse has left it cash poor. What cash Pemex has had available to invest in growing production has been directed at oil, not natural gas. Pemex has neglected spending on natural gas production for years and years. Mexico's appetite for U.S. gas is going to be strong for a long time to come. As pipelines keep getting added to send that natural gas to Mexico, the demand will increase. There are currently 13 pipeline projects being developed in the United States to move natural gas to Mexico. Another 15 pipeline projects are on the go on the Mexican side of the border. And here's a list of all of them. It works out to a lot of natural gas production. Mexican regulators have been pushing the country's power sector to embrace natural gas. The country desperately wants to eliminate fuel oil for power generation. It is much more profitable to use cheap U.S. natural gas for power than consume more valuable oil, which Mexico could have exported. Mexico is also having a manufacturing boom, which drives increased natural gas demand. The dollar-peso exchange rates have made producing goods in Mexico very attractive. Manufacturing companies have been eagerly moving factories south of the U.S.-Mexico border. And Mexico isn't the only place where U.S. natural gas is now being exported to. Our gas isn't stopping in Mexico. LNG exports are surging too. The first of what could be many LNG export facilities is already sending U.S. natural gas around the world. In late February, the first export of LNG from Cheniere Energy's Sabine Pass liquefaction facility was sent abroad. Now look at this chart of potential LNG export terminals that could happen soon. There's 22 export terminals that could happen. By 2018, it is anticipated that LNG exports from the United States will hit 4 billion cubic feet per day. Now, Mexican demand for U.S. natural gas is now equal to the entire Haynesville shale play. By 2018, LNG exports will do the same for all of the natural gas production from the Niobrara in Colorado. LNG demand growth alone would be enough to influence natural gas prices. But it isn't just LNG, is it? There is also enormous demand growth coming from the retirement of coal-fired power. And then again, we can't forget about Mexican demand, which keeps growing. So this summer is going to create a surge in demand on its own if the weather forecasters are correct. All of these forces that I've just explained are moving in the same direction. Add them all together and it is creating a huge demand surge. Everyone is moving to take advantage of American shale gas. And this is happening just as U.S. production is flattening and about to falter. Is there really going to be enough American shale gas for all of this new demand? Maybe, but it certainly isn't going to be at current prices. That's why natural gas prices need to rise a lot, and they need to rise in a hurry. And here's the single best way to profit from the coming spike in natural gas. Here it is, the true low-cost natural gas producer in North America. Now, the number of producer presentations I've looked at and the number of industry conferences that I've attended, and I think of all the calls I've had with management teams, they number in the thousands. And let me tell you what the message is from every one of them. That our company's best asset, our company's crown jewel, the core play on which we've built our business, is the best place to spend money drilling wells that you could find anywhere today. They say it as though they mean it. with such conviction that you want to believe. I don't want to tell you that these hardworking men and women are lying to us when they tell us these things. But maybe we should say they have a delusional view of the facts sometimes. Obviously, every company cannot have the best asset. Only one company truly can. The one company that does has the ultimate competitive advantage. It is the advantage of being the single lowest cost producer. This is the holy grail in this business. If you are the lowest cost producer, you win. It's as simple as that. You win. You win in every sort of commodity price environment. When commodity prices are high, you make the most money. When commodity prices are low, you still make money while enjoying lower service costs. You can grow faster during the good times and still grow during the bad times. Being the true lowest cost producer makes you bulletproof. It makes you untouchable. And most importantly, it makes you a shareholder value creating machine. Now today's a special day because I'm going to present you with a gift. I'm going to introduce you to a very special natural gas producer. Not a natural gas producer with some good assets. Not a natural gas producer with some top decile assets. I'm going to serve to you on a silver platter the lowest cost natural gas producer on this continent. This is no joke. This company has the best natural gas play in the business. The company's financial statements prove it to be true, not just the PowerPoint. This company can make money with natural gas prices under 90 cents. How do you know when you have truly found a special natural gas producer? It's a combination of a few things. Let me tick a few boxes for you. First, a special producer can grow without issuing new equity. If you have ever had a look at the balance sheet of the shale oil and gas producer that led the horizontal production boom, you will know that it was a boom built on constant equity issuances. They kept doing new financings. Anyone can grow production if they spend enough money. The truly great assets are so profitable, they allow companies to grow without issuing new equity. A company that actually has the highest rate of return asset should be able to recycle that cash so quickly that it can grow without relying on handouts from strangers. This company can do that. Second, a special producer should be able to grow without piling on debt. Again, if you have a look at the vast majority of shale producers, you will find that their growth was built almost exclusively through the use of external financing, debt or equity. Anyone can grow if they throw enough money into the ground. Below average assets can create growth with a mountain of money, but the exceptional assets allow you to grow without loading your balance sheet up with debt. This company has an exceptional balance sheet. Third, a special producer generates actual financial results that detail the superiority of its assets. Everyone spends so much time looking at company PowerPoint presentations, and not enough time actually digging into cash flow and income statements. When you actually drill into the financial statements, you can see which companies talk about having great assets and which companies actually do. This company's cash flow statements show you the true results of investing capital into its assets. Money goes into the ground, a lot more money comes out. I want to let you have a look at the true lowest cost natural gas producer in North America. I'm not exaggerating. I'm not guessing. The financial statements make it absolutely clear. This company has the best piece of land on the continent. That isn't opinion. The hard data tells us that it is so. I'm going to run through some facts to back this up. Fact 1. This company's operating cost for producing natural gas is 30 cents an MCF, or million cubic feet. You read that right. I said 30 cents. Find me someone with lower operating costs and I'll eat my hat. Fact 2. This company's all-in corporate cash costs are just 88 cents. What that means is that when you include all expenses, even those not related to production, interest, office, anything, that this company can turn a profit with natural gas under 90 cents. This company's all-in cash costs are a full dollar lower than its competitors. That isn't a small advantage, it's a huge advantage. Incredible. Costs that are 60% less than a normal producer. Fact 3. in the most depressed natural gas pricing environment in recent memory, this company will still grow by a whopping 40% this year. This is the true measuring stick for how good a company's assets really are. If you are truly the low-cost producer, you can do things that seem impossible, like growing 40% when natural gas prices have collapsed, and doing it without compromising your balance sheet. Fact 4. This company has more than 76 years worth of drilling of these incredible wells ahead of it. Do I have your attention yet? When you have the best piece of land on the continent, you have the best piece of land on the continent. This company has productive zones stacked on top of productive zones, zones that can be tapped into from the same drilling pad. The flow rates are incredible relative to the costs involved in drilling these wells. All of those stacked formations create incredible cost efficiencies. And the unique assets create the high flow rates. The company's performance makes the quality of these assets obvious. Since 2010, production for this company has increased 8 times. Even this year, with natural gas prices decimated, the company is still growing by 40%. Everyone claims to have great assets. The truly great assets reveal themselves in the numbers. This is the lowest cost natural gas producer on the continent. At higher prices, it will grow at astounding rates. At lower prices, it still grows faster than most competitors can during the boom times, and it can do it for years to come. Michael Jordan could do things with a basketball that no other player could. Stephen Hawking can solve problems that the rest of us can't. Usain Bolt runs faster than every other human. There can only be one true number one. When it comes to natural gas assets, this company has them. If you are at all interested in profiting from the coming natural gas price spike, you have to make sure you know about this company, because all others pale in comparison. The good news is I'm going to tell you all about it. I'm talking about quality in every aspect. It starts with management. I will not accept anything but a top-tier management team. In the oil and gas business, management is everything. If I don't like management, I will not own shares of the business. I want a management team that has proven that they can build a profitable business. A management team that is fully aligned beside shareholders through a significant ownership of shares. I study the earnings conference calls for companies and make sure that after they say something, they do it. If management passes my tests, the next thing I look at is the quality of the company's balance sheet. If a company isn't underpinned with a rock-solid balance sheet, I've got no interest in owning shares. In the commodity business, running with a bad balance sheet will eventually catch up to you. A good balance sheet is a competitive advantage. It allows you to buy assets from the weak players at tremendous prices. Now, if both management and the balance sheet check out, I'll then move to the quality of a company's assets. Again, I'm looking for quality. I only want companies that have assets that are in the top 10% of the industry. The reasons for this are simple. First, that allows companies to continue to be profitable at lower commodity prices than their competitors. That is a huge advantage. Second, the best assets result in the highest returns on invested capital. And that, my friends, is another way of saying that I want to harness the power of compound interest. Over a period of several years, the companies that can invest capital at the highest rate of return will be the ones that can profitably grow production, which at the end of the day will drive share price performance. Now, I have a comprehensive report ready for you on a company that ticks every single one of these boxes. Top quality management, a best-in-class balance sheet, assets that are in the core of the best natural gas play in the country. I'm certain that natural gas is about to go on the face-ripping rally of the century, and if that happens, this company's stock will do extremely well. But if for some reason I'm wrong and natural gas prices don't respond, this company will not only still thrive, it may do even better. It's the best possible scenario. Heads, you win. Tails, you win even more. While this entire industry is falling apart, this company has the financial resources to take advantage of it. Now let's get ready to have some fun. Here's how you get your free report. Claim a 30-day risk-free trial subscription to my Oil and Gas Investments Bulletin. My comprehensive report on how to profit from the imminent, historic natural gas rally is reserved exclusively for subscribers to my Oil and Gas Investments Bulletin. Right now, for a limited time, I'm offering a risk-free 90-day trial subscription to this service that will allow you to claim your risk-free copy of this report via immediate digital download. This will allow you to trial my service risk-free for 30 days. That's my money-back guarantee to all new subscribers. So, if for any reason the service isn't right for you, just let us know inside the first 30 days. We'll return your subscription fee in full right away. And you can keep everything you've received with your membership. One last thing you'll get with my new trade that you rarely see from other investment newsletters. I'm going to follow up with you on its progress. You see, I'll talk about it live on one of my upcoming subscriber conference calls coming up soon. We'll be covering every step of this trade at length. I'll tell you more about the coming natural gas rally, how this company is perfectly positioned, and more. Then I'll go over my other portfolio positions. Next, you can ask me any questions about any of the open positions, where I'm overweight, and which positions and subsectors I'm looking to get into. Honestly, subscribers find this live conference call to be tremendously helpful and a great edge to help their investments. It also shows you firsthand how much legwork I do every day to help you grow the energy part of your portfolio. In fact, here's what you'll get as a new subscriber. Regular issues of the Oil and Gas Investments Bulletin. You'll get full updates on the positions in my personal portfolio. What I'm buying, what I'm selling, and why. In other words, every time I make a move, I'll show you exactly how to get into position for profits. Buy-sell alerts. You'll get these alerts sent directly to your email inbox. That way you'll have the opportunity to take quick action on your trades. Quarterly conference calls. These are live Q&A sessions where subscribers can get updates directly from me on any position in the OGIB portfolio. Interim bulletins. I'll send you these updates whenever I have a time-sensitive insight to share that could impact an existing position or set the stages for a new position. 24/7 members-only web access. You'll get a dedicated password for accessing the OGIB portfolio along with every weekly issue, buy-sell alert, interim bulletin, special report, and guest commentary I've ever published. And as soon as you sign up below, you'll get access to the trade that stands poised to make 2016 your most successful year yet, all thanks to the upcoming historic surge in natural gas. I'm Keith Schaefer, editor of the Oil and Gas Investments Bulletin. To claim your free report, click on the button below.